Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Garrett DeSimone. He's the head of Quant over OptionMetrics. We're going to discuss the Fed, market volatility, and of course, we'll have to touch on meme stocks. Garrett, it's great to have you back with us in studio, and I want to talk about what you're seeing in Nasdaq volatility as we're going into the all-important Jackson Hole meeting on Friday.
Happy to be back, Jill. So what we've seen over the last few days is an increase in Nasdaq vol, specifically measured by the VolQ index. And this is derived basically from a few of the Fed members coming out with hawkish commentary, which has led to a sort of uncertainty about what size the hike will be. And I think regarding what the Federal Reserve officials could do is really set a certainty around that to bring some of that volatility down.
Right, and of course, they're trying to distinguish, the unpredictability around what's happening in September, where Fed funds rates are going to be, what the actual rate is going to look like. So it's spilling over to, a number of asset classes. Right,
and we can clearly see this is where the equity volatility is coming from. So if we look at USD yen, for example, we see an uptick in futures options volatility there, as well as in the 10-year yields, which spills over into this equity vol and bringing that uncertainty there.
Right. Well, and not to mention September and October are seasonably, volatile times for the market as well. Plus, we have midterm elections coming in November, so there really kind of is the perfect storm. Of course, you have to throw earnings in there as well. Any one of these events could be a catalyst for market movements. I want to talk to you about what happened with the meme stocks. Give us some background there. Is that play over with? Are there fresh meme plays that you're paying attention to now?
Sure. So what we've seen over the last few days, specifically with Bed Bath & Beyond, is we saw a large institutional investor, namely Ryan Cohen, come in. And once the information was disseminated that he had taken a large position in calls, this got the community very excited. And essentially it was a pump up. Ultimately, what happened is he had dropped out of his position, and that had essentially created a cascading effect where all of these other retail investors sold off their trades, so the excitement had died down.
Right.
What we see going forward in the meme stock area is these sort of pockets where these names will pop up, there may be a big institutional player in there, it'll generate a lot of excitement, and then fizzle out. Because the capital for these retail investors can really only be spread over 2 or 3 stocks at one time.
Right, and it seems to happen when we get momentum back into the market. I mean, we saw the run from June to where we were mid-August when Nasdaq 100 was up, over 20%. It seems to be that these meme plays happen when there's a lot of exuberance in the market.
Right, exactly, and some of the hawkish commentary out of the Fed, I think, contributed to the selling and the ultimate, collapse of these meme stocks. And the reason being is these meme stocks also tend to be companies that carry a lot of debt burden, right?
Right.
So when the when uncertainty increases and rate uncertainty increases, the refinancing opportunity might not be there for them. So this also brings a headwind to these kind of stocks.
And remainder, high level for the remainder of the year, what do you think? Continue to see more volatility, or it'll kind of phase out towards the end of the year? Do you think we'll continue to see the chop that we've experienced for most of 2022?
I think we're going to look at 2 important days next month in September. That'll be the unemployment number and the CPI number, which will ultimately dictate the Fed decision. So if we get a higher than expected unemployment number, that'll actually, I think reduce volatility in the market, because the market participants will take that as a view of, okay, the Fed will not be as aggressive in hikes. The same thing goes for CPI. If we see a lower CPI, then that'll bring down some of the expectation about how hawkish the Fed will be. But those 2 days are crucially important for, and ultimately what the FOMC decision will be at the end of the month.
So bad news is good news.
Bad news
is good news. We've seen that play out before. All right, Garrett, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.